Hey, it's Darius. Scores are out, and congratulations to those who passed the CPA exam. And thanks for noticing the I-75 difference. So if you're struggling with TCP or REG or any of the CPA exams, look at this. I watched pretty much all the I-75 lectures and did not do practice questions. You can do some practice questions. It's okay. You got my permission. I-75 has thousands of practice questions. So if you didn't pass, don't get mad. Get yourself on I-75 with me, Darius Clark, because the right teacher makes all the difference. All right, what do we have to know about passive activities? And for the CPA exam, this could be tested in TCP and also in REG. We'll start by saying that there's three major types of income. There's earned income, which includes W-2 employee wages, and also Schedule C of 1040 for the sole proprietor, small business owner. That's earned income. Then there's portfolio income, which includes interest and dividends. And then there's passive income. Passive income includes real estate rentals and also business where the taxpayer owns the business but does not materially participate. And you should know that almost all income fits into one of these three buckets. And in this video, we're going to be focusing on the passive income. All right, here's an example of a passive activity where the owner of a business does not materially participate. Dr. Kumar has a successful medical practice, and he sets his brother-in-law up in a chicken franchise. Dr. Kumar pays the franchise fee and maintains 100% ownership of the business, but he never works there because he's a doctor. He's in the hospital. He's in his doctor's practice. The franchise loses $30,000 the first year. That's the chicken franchise. Well, this loss is considered passive to Dr. Kumar because he doesn't work there. The exam will be very clear. Since it's passive, Dr. K cannot deduct this loss against his $250,000 salary that he earns from the hospital. So he carries the $30,000 passive loss forward, and he carries it forward indefinitely. See, it's very possible that when Dr. Kumar bought the chicken franchise for his brother-in-law, he realized he's going to put it in his own name, and then it's probably going to lose money, and he'll be able to take that loss and deduct it against his high salary. His earned income is $250,000, but his passive loss is $30,000. Can he net the two out? And the answer is no. All he can do is carry it forward. So we go to year 2, and in year 2, Dr. Kumar's chicken franchise had a profit. Remember, last year was a loss of $30,000. This year's a profit of $4,000. His W-2 from the hospital is once again $250,000. Well, the $30,000 passive loss that carried forward from last year, that can be used to offset the $4,000 of passive income this year from the chicken franchise. So we can take the $4,000 passive income and offset it with the $30,000 passive loss that carried forward from last year. Still, there's a $26,000 passive loss that can't be used yet, so that'll carry forward to year 3. Notice, though, that Dr. Kumar cannot deduct the $26,000 net passive loss against any of his salary from the hospital. And that's one of the reasons why early on I emphasized that there's 3 types of income: earned income, portfolio income, and passive income. And now you know it's not so easy to take a passive loss and offset earned income. And it's quite possible that if a business owner like Dr. Kumar knew that going in, he may never have invested in the chicken franchise. Let's try this question. A taxpayer has a W-2 with $500,000 in income. The taxpayer has 2 passive losses, one for $20,000 and the other for $30,000. The taxpayer has passive income of $10,000. How much passive loss is deductible in the current year? So the general rule for passive losses is that they're only deductible against passive income. What if there was no passive income at all? See the $10,000 of passive income? What if there was none? Well, the question asks how much passive loss is deductible in the current year. If there was no passive income, the answer would be 0. None of that $50,000 of passive loss would be deductible against the $500,000 of earned income from the W-2. But because there is $10,000 of passive income, That's how much passive loss can be deducted this year. So the answer is B, $10,000 is the amount of passive loss that's deductible in the current year, because you can always offset passive income with passive losses. But it's important to note that if there was no passive income this year, then the answer would have been 0 and all $50,000 would have been carried forward. But in this case, $10,000 is going to be the deductible passive loss and $40,000 will be the passive loss carry forward. Here's how I want you to sum up passive activity gains and losses. All passive activity gains and losses are netted to arrive at a single number. If this net number is a gain, it's taxable. So if all you have is a passive gain, it's taxable. But if you have a net passive loss, we know it cannot be deducted against earned income unless it's from a real estate rental activity. Okay, so there's an exception to the rule now. Yes, if there's a real estate rental activity and that's what's creating the passive loss, then you can deduct the passive loss against your earned income, your W-2. If you have losses that can't be deducted this year for whatever reason, maybe they're not from a real estate rental, they can be carried forward indefinitely. Let's try this question. In year 2, Kelly had a passive gain of $1,000 and a passive loss of $5,000. Kelly also has a salary of $50,000 from her regular job in year 2. No part of the passive loss is from rental activities. What is Kelly's net passive gain loss for year 2? Notice they didn't ask how much was deductible. They said how much is the net passive gain or loss. Well, she has a passive loss of $5,000, a passive gain of $1,000, and all passive gains and losses are netted. And in this case, you have a net passive loss of $4,000, which happens to be answer choice A. So your $1,000 passive gain and your $5,000 passive loss nets out to a $4,000 passive loss. A is the answer. Here's how that question might look on the exam. In year 2, Kelly had a passive gain of $1,000 and a passive loss of $5,000. Kelly also has salary of $50,000 from her regular job in year 2. Determine how much net passive loss is deductible by Kelly in year 2 against earned income, assuming Kelly owns no investment real estate. So this time they're asking how much of the loss is deductible. So you first have to calculate the passive loss, which we did in the previous question, by netting the passive gain of $1,000 and the passive loss of $5,000. So we have a passive loss of $4,000, but none of it's deductible because she doesn't own any investment real estate. And the answer is D, none of the $4,000 net passive loss is deductible against earned income in year 2 since she owns no rental real estate. See, the government actually encourages you to invest in real estate, and that's why you're allowed to deduct passive losses to a certain extent against your earned income, as long as those passive losses were caused by rental real estate. If those passive losses were caused by owning a business that you don't participate in, like Dr. Kumar, then there would be no passive loss deduction in the current year. You would just have to carry it forward. Okay, now we have to take a closer look at rental activities, because rental activities are considered passive activities, just like owning a business where you don't participate. If you have a 2-family house and you're renting out part of it, or you own an apartment building and you're renting it out, that's considered a passive activity. Rental income is basically rent revenue minus the direct expenses. And what schedule on a tax return are we going to report rental activities? The exam will expect you to know Schedule E. Schedule E on the tax return is where rental income and rent expenses are reported. Let's take a look at Schedule E. And here you can see the Supplemental Income and Loss Schedule E of 1040. The Stricklands own a 2-family rental in Arizona, and the rents received are on line 3 here, $24,000. But they don't pay taxes on the gross amount of the rental. Taxes are paid on the net, which is all the way down here. $1,228 is the net after deducting all these rental expenses. Things like advertising for tenants and cleaning and maintenance and insurance, legal and professional, mortgage interest paid, repairs, supplies, taxes, depreciation. That all adds up to total expenses of $22,772, and when subtracted from the rent income of $24,000, there's still a little profit of $1,228. And this 1228 is considered passive income because real estate rentals are passive activities. So we said even though rental income is viewed as a passive activity, if there's losses up to $25,000 can be deducted against earned income. If the owner actively participates in the activity, the exam would have to say, and the owner does not have adjusted gross income that is over how much? $150,000 per year. And that is one of the few thresholds that I want you to know. They will ask you on the exam about this threshold of $150,000 AGI when it comes to the ability to deduct a rental loss. So you can deduct a rental loss up to $25,000 if you have one, unless your AGI is over $150,000. Let's try this. Allison incurred a loss of $30,000 in year 6 from rental real estate in which she actively participated. Allison, an unmarried individual, had an adjusted gross income of $200,000 for year 6. What amount of loss attributable to this rental can be used in year 6 to offset income from non-passive sources? So she has a rental loss, maximum $25,000 is deductible, but look at her AGI. It's over $150,000. So she's not going to get any deduction even though she materially participated in the rental. So the answer is going to be 0, which is answer choice A. No passive loss deduction for rental activities is allowed in the current year if AGI is over $150,000, and here it's $200,000. The entire $30,000 loss carries over to next year. Let's try this one. Cindy, an unmarried individual, had AGI of $75,000 for year 6. Cindy incurred a loss of $30,000 in year 6 from rental real estate in which she actively participated. What amount of loss attributable to this rental can be used in year 6 to offset income from non-passive sources? So same idea. You have someone with a rental activity that they materially participate in who has a loss and wants to deduct that loss against their earned income. And can she do it? This time she can, because her AGI is not over 150. In fact, it's under 100,000. As long as it's under 100,000, then you can deduct the full amount of rental loss up to 25,000, which makes the answer C and not D, because even though the rental loss is 30,000, the maximum that you can deduct is 25,000 in the current year, and you'd carry the other 5,000 forward. So now we've seen the rental loss deduction when the AGI is under 100,000, and we've seen that there's no rental loss deduction allowed when AGI is over 150,000. What happens when AGI is in between 100 and 150? And if you're finding this video helpful on passive activities, get yourself on I-75 with me, Darius Clark, because the right teacher makes all the difference. Hey, it's Darius. And once you start using I-75 CPA Review, you're going to be looking forward to score release day as much as I do. So congratulations to all those I-75ers who recently passed the CPA exam. If you didn't pass, don't get mad. You might just need to get on a better road. So get yourself on I-75 because the right teacher makes all the difference.